Incentive stock options. If you've got them, you know you're sitting on what could be a life-changing amount of money. But you also know they are, well, incredibly complex. So, in the next few minutes, we're going to demystify them. We're going to give you the clarity you need to make way smarter decisions about your equity.
All right, here's our game plan. We'll start with the absolute basics. What is an ISO anyway? Then we'll get into the two crucial tax paths you can take. We'll talk about something called a qualifying versus a disqualifying disposition, look at an advanced strategy, the early exercise, and then we're going to tackle the dreaded alternative minimum tax. Finally, we'll pull it all together so you can figure out what's right for you. And this really is the bottom line, isn't it? The choices you make can lead to wildly different outcomes. If you play your cards right, it's a huge win. But a misstep? You could end up leaving a massive chunk of your money on the table for Uncle Sam.
So, let's start at square one. What exactly did your company give you? Because here's a spoiler, it's not stock. At least, not yet. Let's break down what that grant letter really means. Okay, here's the official definition, but the key phrase is right to buy. Your company has basically given you a coupon that locks in a purchase price. That's your exercise price. So if your company takes off and the stock is worth a fortune, you still get to buy it at that original super low price. That gap between what you pay and what it's worth, that's your profit. Your options go through this whole life cycle, right? Grant, vesting, exercise, sale. But here's what I really want you to zero in on. Steps 3 and 4. When you exercise and when you sell. Those are the two moments that completely define your tax bill. The timing of those two actions, it's literally everything. So, you've pulled the trigger, you've decided to exercise. You are now at a huge fork in the road. You own the shares, but what you do next is absolutely crucial. Yup, you're officially a shareholder. And guess what? A tax clock just started ticking. Your very next move is going to determine how much of that hard-earned profit you actually get to keep. And really, it comes down to two choices. Path 1, we'll call it the patient path. You hold on to the stock for a while to get a much, much lower tax rate. Or there's path 2, the fast path. You sell them quick, get that cash in your bank account, but you're going to pay a significantly higher tax bill for that speed. Okay, let's learn the lingo, because the IRS has official names for these paths. Path 1 is a qualifying disposition, and Path 2 is a disqualifying disposition. The names kind of say it all, right? So let's look at the actual rules of the road. And here they are. These are the rules that make all the difference. To get that sweet low tax rate, you have to hit 2 checkpoints. First, you have to sell your shares more than 2 years after they were granted. And you have to sell them more than 1 year after you exercised. Hit both of those? Awesome. Your whole gain gets taxed at the low long-term capital gains rate. But if you miss even one of them, a big chunk of that same gain gets relabeled and taxed as ordinary income. And that's a much higher rate. So let's put some numbers on it. If you follow the rules, if you do a qualifying sale, the absolute maximum federal tax rate you're going to pay on that profit is 20%. But if you sell too soon, if it's a disqualifying sale, that part that gets taxed as ordinary income could be hit with a rate as high as 37%. Think about that. That's a massive difference in your take-home pay, and it all just comes down to timing. All right, so knowing all that, what if you could get way ahead of the game? Some companies allow for this really powerful kind of advanced strategy called an early exercise. It lets you buy your shares before they've even vested. Now, the potential upside here is huge. By exercising right away when the market value is the same as your exercise price, you might pay 0 tax upfront. It also starts those holding period clocks we just talked about years earlier. But the risk is very real. You are paying your own cash upfront for shares in a company that might not make it. And get this, if you leave before you're fully vested, the company can usually buy those shares back at the price you paid, which means you don't get a refund on any taxes you already paid on them. Ouch. If you do decide to early exercise, this form is absolutely non-negotiable. An 83B election tells the IRS, hey, I want to pay my taxes now based on today's value. If you don't file it, the tax bill comes later when the shares vest, and by then their value could be way, way higher. And believe me when I say that 30-day deadline is one of the strictest in the entire tax code. There are no exceptions. Okay. Time to talk about the one thing that causes the most headaches and confusion, the alternative minimum tax, or AMT.
If you exercise your ISOs and then hold on to them past the end of the year, you are probably going to run into this beast. You know, the best way to think about the AMT is like it's a parallel tax universe. It's a completely separate tax calculation. So the IRS figures out your tax bill the regular way, and then it does it all over again using these different AMT rules. And your job? You pay whichever one is higher. The reason ISOs trigger it is that the paper gain, that difference between the market value and your exercise price, is counted as income in the AMT universe, even though it's not in the regular one. But here it is. This is the most important thing to understand about the AMT, and it's a total game changer. The AMT you pay, it's not just gone forever. It actually works more like a prepayment. Think of it like a credit that you can often get back in future years. So how does that work? Well, when you pay AMT, the cost basis of your stock for AMT purposes gets bumped up to whatever the market value was on the day you exercised. But for regular tax, your cost basis is still that super low exercise price. So down the road, when you finally sell, your taxable gain is much smaller in the AMT system. This difference is what lets you apply that AMT credit you've built up to lower the regular tax you owe in the year you sell. So in the year you exercise and hold, this is probably what it's going to look like. Your AMT calculation is higher, so that's what you pay. But just keep telling yourself that extra amount, it isn't lost. It becomes a credit you can likely use later. It just takes some really careful planning. Okay, let's bring it all home. We have covered a ton of ground, I know. But everything we've talked about really just boils down to a handful of key trade-offs that you and only you can decide on. Look, there's no single right answer here. It's a totally personal calculation. Are you someone who prioritizes getting cash in hand right now, even if it means a bigger tax bill? Or are you in a position where you can be patient to really maximize what you take home after taxes? Can you stomach the risk of an early exercise for that huge potential tax benefit? Answering these questions for yourself, that's the key to your whole strategy. You know, the whole point of this explainer wasn't to give you all the answers. It was to arm you with the right questions and a really solid understanding of the rules of the game. So your next step is to take this knowledge, apply it to your own life, your own finances, and have a much more powerful conversation with a tax pro or a financial advisor to build the winning strategy that is perfect for you.